We're heading for another silver squeeze. Mike's forecast will be correct. According to the Silver Institute, it's only something like 76 million ounces. According to UBS, it's about 300 million ounces. Individuals are stacking silver in China. The idea that silver could easily go up to somewhere like $300 or $500 an ounce, I think is eminently possible. And on top of that, if you look at the price of gold, so we're now linking it, if you like, through the gold-silver ratio. I mean, basically what the price of gold is doing is it's reflecting a declining purchasing power of the dollar. Now, what China has done is it turned around and has banned the export of fertilizers. So then you link through gold-silver ratio into silver, and you could be seeing $300 to $500 quite easily. Chinese government has been supplying silver into the Western markets, which explains why we have last 7 years of deficit between supply and demand, without knowing really where that imbalance was really sorted out. It was really being done by China out of her accumulated stocks of silver. She was trying to control the price.
Last time we talked, you said China could be considering backing the yuan with silver. Do you think this is connected to such an initiative? And how will this massive intake of silver affect the supply side of the market?
I don't think it's connected with that. I mean, whether the Chinese are thinking about putting the domestic yuan onto a silver standard while it's on a gold standard for international trade is obviously a speculative suggestion. No, the problem, I think, is that there is a clash between industrial demand, which is soaring off the charts, and investor demand, or, if you like, demand on a monetary basis. I mean, it was interesting because the chart which everybody saw was posted by Bloomberg. Now, what Bloomberg did not post it was a chart showing, if you like, the China's exports of silver. Now, this is very, very important because China exports silver in the form of bullion, or it did rather, in the form of bullion and powder and so on. So, the export statistics cover all that. Now, what the Chinese government has been doing is it's been supplying silver into the Western markets, which explains why we have the last 7 years of deficit, if you like, between supply and demand, without knowing really where, that imbalance was really sorted out. It was really being done by China out of her accumulated stocks of silver. She was trying to control the price.
The market usually reacts to import headlines while missing the far more revealing export story behind them. As Alasdair Macleod points out here, the real signal is not China buying silver, but China quietly feeding Western supply for years to suppress visible shortages. That changes how investors should read the last 7 years of deficits, because the gap may never have been resolved by mining output at all. When industrial demand and monetary demand collide at the same time, pricing models built on normal cycles can break very quickly. Next, Alasdair Macleod discusses why China's sudden policy shift may be even more important than the silver it already moved.
The interesting thing is that if you look at her exports, she has been exporting, I think I made a note of the numbers, in 2024, she exported 42,000 tons, 4,200 tons. In 23, 4,083 tons, etc. Now we're looking at figures like, sort of 137 million ounces is what she did in 2024. If you look at that Bloomberg chart showing the imports, in that year she imported a figure like 300 odd tons, I guess, 330 tons. Now, what is absolutely amazing is that in 2025, China ceased exporting silver entirely. The figure for 2025 is zero, absolutely zero. So why is this? I think basically China has sort of realized that the demand for silver, I mean, with nations like India getting into the photovoltaic industry, producing huge amounts of these solar panels and all the rest of it. Plus, obviously, also the defense applications and all the rest of it around the world, electronics applications all around the world and all the rest of it. The drawdown on her silver stocks, which she has accumulated over the last, I think, sort of 4 or 5 decades, has been massive. So there had to come a point where, they sort of said stop. And I think that's basically what happened in 2025.
A market can ignore a shortage for years until one country simply stops filling the hole. As Alasdair Macleod points out here, China moving from roughly 137 million ounces of exports in 2024 to 0 in 2025 changes the entire supply equation overnight. That matters because solar expansion, defense demand, and electronics manufacturing are all competing for the same shrinking pool of metal. Investors often focus on spot price while missing the structural shift underneath it, and those are usually the moments that reset long-term valuations. Next, Alasdair Macleod talks about how geopolitics may now be tightening silver even faster than industrial demand.
Plus, obviously, geopolitics was beginning to play into this. It was in September that we had rare earths suddenly halted the export of rare earths. Why? Because President Trump threatened China with an extra 100% tariffs or something. I can't remember the details. But and interestingly, it was literally within a couple of weeks of that was end September last year, within about a couple of weeks of that, I think on about October the 9th, the lease rate in London suddenly shot up to 40%. Suddenly there was a huge, great shortage of physical silver available for delivery. So this is fascinating. So if you look at the that Bloomberg chart, which I think you're probably referring to because it's all over the internet, the social media, there is a big difference, I think, between previous years, because if you look at the figures for previous years, the amount of silver being exported by China is well in excess of the recorded imports. In other words, there was they were literally feeding on a net basis silver into the rest of the world. That has now stopped. And not only that, but if you look at, there's a premium now, has been for some time, premium of about sort of 12, 13, 14% for silver in Shanghai. Now, a lot of this is explained by the fact that imported silver has to bear a VAT of around about 13%.
Sometimes the loudest warning in a market is hidden inside a lease rate almost nobody watches. As Alasdair Macleod points out here, London's silver lease rates jumping toward 40% after geopolitical trade, tension was not a routine move, but a stress signal. The Shanghai premium staying near 12 to 14% shows domestic buyers are still willing to pay above global pricing despite added tax costs. That suggests the paper market and the physical market may be telling two very different stories to investors right now. Next, Alasdair Macleod unravels why that East versus West disconnect could become much harder to ignore.
But nonetheless, domestic buyers of silver in China are prepared to pay a premium. Okay, it includes VAT, but they're still prepared to pay it. What's happening is that silver is basically being sucked out of the West in exactly the same way as gold has been sucked out of the West over the last 30-odd years. So you can see this is actually a major turnaround. And it's leading, I think. We saw this, the initial squeeze in last October reflected in a 40% lease rate on the LBMA. I think we're heading for another squeeze. I really do. And the real conflict is this industrial demand, which is soaring off the charts, plus monetary demand, if you like, from all around Asia, because I mean, the last monetary metal which they tied their currencies to was silver. So you can see that there's a greater predilection for silver, if you like, as protection from the debasement of fiat currencies in Asia than there is with us. I mean, we've always seen it as the minor monetary metal, the real monetary metal being gold. So this is it's a fascinating juncture. You've got this clash, and it's really, really going to accelerate, I think, in the coming months. So that's basically the background to what's going on. And when I look at the report coming out of the major bullion houses and so on and so forth, I mean, I was just absolutely amazed. You had UBS forecasting a 300 million ounce deficit, supply deficit in the current year. And they were saying, well, it'll drive the silver price up to $100 and then it'll come back down to 83 or something by March following, March 27. These guys, they don't understand that there is a geopolitical dimension to this as well. I mean, for a start, they don't understand the monetary angle, let's face it, because they're all Keynesians, basically. That's what they were taught. This is I think everybody's being caught out by what's going on. The geopolitical thing is quite simple. There's no way that China is going to continue to supply silver into the global market when the US has decided that it is a critical mineral and they've got to start accumulating it. So are the Chinese going to supply it to America? Are they hellers like? They certainly are not. So you can see that, this is a real crisis developing.
Investors may be underestimating how quickly a supply story can become a strategic crisis. As Alasdair Macleod points out here, a projected 300 million ounce deficit means silver is no longer just an industrial metal, but a geopolitical asset. Western analysts still model price as if trade flows will remain rational, even while nations are beginning to treat critical minerals as national security reserves. When monetary demand in Asia meets industrial demand worldwide, old valuation assumptions can become dangerously outdated for portfolios. Next, Alasdair Macleod discusses why some mainstream price forecasts may be missing the biggest force now driving silver.
I want to touch on the silver price for a moment here because Michael Oliver, whom I've had many discussions with alongside you over on the VRIC Media channel, recently came on this show and predicted that silver would rise to $300 to $500 an ounce at some point this year. He's watching momentum-based technical charts, and he has his own method of analysis that he's used to reach that conclusion. But do you think this is a realistic price target? And what are your overall thoughts on how the silver market will play out for the remainder of 2026?
Yeah, well, I have the greatest respect for Mike. When he came out with that, I thought, hold on a minute, I better actually have a look at the underlying situation and try and approach it from a fundamentalist point of view. And as a result, I put out a Substack article, I think it was yesterday or the day before, which looked at China's imports, its exports, which is now completely ceased, the rationale behind it, etc., etc. And I have to say that looking at these fundamentals, I think it is certainly very, very likely that Mike's forecasts will be correct, will prove to be correct. We're heading for another silver squeeze. It's really the best way to describe it, I think, is the combination of China has been supplying the market up until the end of 2024.
Price targets sound sensational until the supply math starts validating what once seemed extreme. As Alasdair Macleod points out here, the more important shift is not the $300 headline, but the fact that China stopped cushioning the global silver market after 2024. Investors often dismiss technical projections because they seem detached from reality. Yet sometimes fundamentals quietly catch up to the chart before most people notice. When a long-running supply source disappears, valuation models based on older inventory assumptions can become dangerously stale for portfolio planning. Next, Alasdair Macleod discusses why the deficit itself may be larger than official industry estimates suggest.
It ceased doing that completely. The market has been in deficit for the last 6 years. We're into our 7th year of deficit, which, according to the Silver Institute, is only something like 76 million ounces. But according to UBS, is about 300 million ounces. 296, I think, was the figure they came up with. So, it's going to be quite a bit greater, perhaps, than the Silver Institute actually forecasts. You have the production of solar panels accelerating. Oh, and incidentally, the Chinese actually turned around to their solar panel industry and said, please, can you slow down your production? Now, I think this is further confirmation that they're a bit worried about the stocks having run out and future demand, if you like, for industrial demand for silver, and the way individuals are stacking silver in China. Remember, you've got about, 1.4 billion individuals there, and they are savers. The savings rate in China is like 30 to 35%. I mean, we're looking at over $5 trillion of savings looking for a home every year. And that's in addition to what is already there. Where do they go? Property? No. Stock market? Maybe, but not really. It's all been going into bank deposits, and bank interest rates in China have been dropping. So that's less attractive. So you can see why it is that individuals feel that, the best thing we can do is buy gold, buy silver.
The gap between a 76 million ounce deficit and a 296 million ounce deficit is not a rounding error. As Alasdair Macleod points out here, that kind of discrepancy can completely change how investors judge risk in the silver market. At the same time, China asking parts of its solar industry to slow production hints that physical availability may already be influencing policy decisions behind closed doors. When household savings exceed $5 trillion annually, even a small move toward hard assets can tighten supply faster than analysts expect. Next, Alasdair Macleod talks about how currency weakness could amplify that pressure even further.
That's what they're doing. So I think this, to answer your question, the idea that silver could easily go up to somewhere like $300 or $500 dollars an ounce, I think is eminently possible. And on top of that, if you look at the price of gold, so we're now linking it, if you like, through the gold-silver ratio. Basically what the price of gold is doing is it's reflecting a declining purchasing power of the dollar. We are going to see a massive decline in the purchasing power of the dollar by the end of this year. Now, the reason I say that is because of the knock-on effects of Hormuz being closed. I wouldn't be surprised if the Houthis start kicking off at the Mandeb Straits at the bottom of the Red Sea and close off effectively 6 million barrels a day coming out of Yanbu and effectively closing off Suez. So, there's the implications of this are going to be really quite terrifying. And I mean, one of the big things which people latched onto earlier on is that, of course, the downstream petrochemical products, particularly things like fertilizers, phosphates, sulfurs, and so on and so forth, that's going to really push up food prices. Now, what China has done is it turned around and has banned the export of fertilizers. So what you have got is a knock-on effect.
Commodity markets rarely move in isolation, even when analysts prefer to model them that way. As Alasdair Macleod points out here, silver is increasingly tied to the same currency stress that has been lifting gold as confidence in the dollar weakens. A disruption of 6 million barrels a day through a major shipping corridor would not just hit energy, but could feed directly into fertilizer costs, and transport costs, and inflation expectations. Those second-order effects are often what catch portfolios off guard because they arrive after the first headline fades. Next, Alasdair Macleod unravels how central banks could respond when that pressure reaches bond markets.
Not just what's happening in the Gulf. But you've also got major exporters of these vital commodities saying, well, hold on a minute, we better hang on to what we've got, which basically, if you're a net importer of these things, you are out in the cold. So, this is very, very serious. And how does the Fed respond to this? Well, for a start, it drives up bond yields through the roof. It puts all G7 into a debt trap. And they have to raise interest rates. Unless, of course, they decide that it's actually politically better not to, in which case they're sacrificing their currencies. So, if you ask me what gold is going to be at the end of this year, it's just going to go through the roof on the back of these dynamics. It's as simple as that. So then you link through the gold-silver ratio into silver, and you could be seeing $300 to $500 quite easily.
The real risk may not be inflation itself, but the policy trap that follows it. As Alasdair Macleod points out here, when exporting nations begin hoarding strategic commodities, central banks can be forced into choosing between defending currencies or protecting over-leveraged debt markets. Rising bond yields across G7 economies would pressure equities, housing, and government financing all at once. That is why precious metals sometimes reprice suddenly, not because sentiment changes overnight, but because policymakers run out of painless options.